Hello everyone, I hope you guys are doing well and studies going in full swing. Now in today's video, we are going to discuss the important questions and case studies from your AFM MTPs of November 24 series 1 as well as series 2 as well as the AFM RTP. Now as a quick discussion, in case you have limited time, I would say that at least go through the MTP, the second series of November 24, because there are around 3 specific slightly different questions which you should practice. Some of them are MCQs, some of them are descriptive, but that is something that you should do. So over here, we'll first start with the MTP of November 24, the series 2 MTP, and then go backwards into series 1 and then into the RTPs. So let us first go into this case study of case scenario 1 from this MTP. Now this is on a credit default swap. So this was one of the newly added theory sections within your derivatives. Now what is actually a credit default swap? A credit default swap is a private one-to-one agreement which is entered into between two parties in case the holder wanted to protect against a possible default. So what happens over here is, let us say I have purchased bonds. I am the investor. I have purchased bonds of ILNFS, which is a company which was facing, let us say, financial difficulty. Now I have invested in bonds worth 100 rupees. Now these bonds have a term of 10 years. I am worried that these bonds will not give me my principal value back, and hence I need protection. So what I go to look for protection, there's a credit risk which I want to save, and hence there is a writer of the CDS who will tell me that if these bonds will default, then I will pay you for the shortfall in the principal that you will get. So this is a one-to-one agreement between the writer and the holder, where the writer is giving kind of an insurance or protection that if there is a default, I will pay you. But will that be free of cost? The answer is no. There will be a premium attached, and hence there would be some premium. Now over here, the holder of this instrument will pay the premium to the writer. Maybe the premium is, let's say, 2% of 100. That is 2 rupees is the premium that will be paid. This may be per annum as well, this may be flat as well, depending on the terms. It's a private agreement, and hence 2 rupees will be paid, for example, as a premium. Now what happens is, if suddenly ILNFS develops some difficulties and they say that we are not going to be able to pay you the money, we will be able to pay you only 40% of the amount, remaining 60% we will not be able to pay, then as a holder of the CDS, a credit default swap, I will recover the balance, that is 60 rupees from the writer, and the writer will have to pay me 60 rupees. Now, this is in case of a net cash settlement where I say that this bond was worth 100, I'm getting only 40, so you have to pay me the shortfall, that is 60. There can also be a physical settlement where I give the entire bond to the writer and say that you give me 100 rupees, so I will not redeem the bond from ILNFS, I'll give the entire bond and redeem back and get, let us say, 100 rupees. Now, this is in case of a credit default swap. The guidelines over here are given by the International Swap and Derivatives Association. So unlike RBI etc., there is an association. Like in foreign exchange, you have FEDI, Foreign Exchange Dealers Association of India. Similar to that, guidelines are given, and usually there will be a payoff in case of a CDS or a credit default swap, only in case of a default. Otherwise, I'll keep on paying the premium. This is called as a swap and not an option, because I don't there's nothing for me to exercise or not exercise. If there's a default, I will get money. If there's no default, I will not get money. So that is why it is more like a swap, and hence the terminology of a credit default swap. So over here, you have been given some background. Mostly this case is more of a theory based case. Having said that, there is a particular problem or so where MCQ where you might have to do some basic calculations. So let us try to review this. Credit default swap we have discussed separately along with the theory section of the derivatives. Now you can probably apply this. Suppose you are a risk manager at a financial institution and your company has loaned a significant amount of 500 crores to a company X. So you have given a loan for a period of 3 years at a 6-month MCLR. So like there is a LIBOR, similarly there is a benchmark rate MCLR plus 200 basis points. You are concerned about X's ability to repay the debt due to the recent market volatility. To protect your institution from the potential default, you decide to purchase a credit default swap. What do you mean by credit default swap? Well, it is a product basically where you as a holder will enter into an agreement with a writer of the credit default swap that in case of a default, the writer will pay us for the shortfall. From ABC bank for the same notional amount. So you are worried about the default of the principal. So the notional amount over here will be the same 500 crores at a premium which is quoted as 1% per year through cash settlement. Cash settlement would be net settlement. You will settle to differences in prices. On the respective reset dates for the same period, the actual MCLR interest rate comes out as follows. So there are various 6 monthly period where you have been given, let us say, the MCLR. To be honest, that is not as relevant in case of a CDS setup, but nevertheless, this is the case. Based on the above case scenario, answer the following questions. First, the primary purpose of a CDS is to increase the value of the bond. No. To protect against the default risk of a debt obligation seems to be correct. Provide guaranteed profit for the buyer. No, that is not the case. It does not guarantee any profit. It just guarantees you that whatever is the principal, you should ideally get back. And create a new form of loan. Not at all. So your answer is sub point B, where you are giving protection to the buyer. Which of the following statements is true about CDS contracts? CDS contracts cannot be used for speculation. Well, they can very well be used for speculations. These are called as like naked CDS. You might not even be the holder of the bond. You might still think that this company will default, so let me go and buy the CDS. So you are kind of speculating over here, and hence there can very well be a speculation over here. So this statement is, which of the following statements is true about CDS? It cannot be used for speculation. The answer is no. False. It can very well be used for speculation. CDS contracts are governed by government regulations. No. At least in India, it is at a very, very nascent stage. There is no government regulations per se for the CDS. CDS are private agreements between two parties. This seems to be true. And it eliminates all risks for the buyer. Not at all. It eliminates just the default risk. There can be other risks like interest rate risk, currency risk. These risks still remain. And hence your answer seems to be point C, where it is just an agreement between the parties. Which organization publishes the guidelines for conducting credit default swap transactions? Federal Reserve, no, this is the US, let's say central bank. International Swap and Derivatives Association, yes. Securities Exchange Commission, WTO, no. So the answer is B, it is a part of your theory. Now comes the numerical section. Assuming no default occurs, the total premium that your company will pay during the designated loan period. Now the designated loan period is 3 years. So the total premium they will be pay is 1% of the notional amount. So this is 500 crores into 1%. Actually, this 1% is agreed to be paid per year, not per 6 months, not flat, per year, and hence into 3. So that is what 5 crores into 3 comes to 15 crores. So your total premium will be 15 crores, ignoring time value. And suppose if the lender defaults somewhere in the beginning of the 3rd year of the loan, somewhere in the beginning of the 3rd year. So it was a 3-year loan and you are now in the 3rd year itself. That is after payment of interest for 2 years, and the market value of the reference loan falls to 75% of its par value. Sir, what is its par value? 500. Market value of the loan will be 75%, so that is probably 375. So maybe you are likely to default on 25%. Then ABC Bank will pay your company X amount in a cash settlement. So we will say, if I am going to recover 375 from the bond, then for the remaining 25%, that is 500 into 25%, that is 125, which I am unlikely to recover, I will get that money from the CDS. CDS is against the principal value of the loan and not necessarily against the interest payments, and as a result I will command 125 crores. This is your answer to point 5. Now when you read this MCQ looking at the word credit default swap, our heartbeat races. But to be honest, this is, even if in the exam questions like these come, don't get scared and leave them. Read it once. Most likely you will be able to crack it based on your overall understanding, even if you have done basic theory reading. Okay, so this is case scenario 1. Case scenario 2 is exactly the same question that is there in the study material regarding sensitivity analysis in case of capital budgeting. If required, you can try this separately, but otherwise if you have done the sensitivity analysis part and this question, almost all of that is kind of getting covered over here. If required, we'll come back to this, but first we'll at least tackle up the new parts. The case scenario 3. Now this is on a concept of yield curve. Now what do you mean by yield curve? On yield curve, you will plot the maturity on one side and the interest rates on the other side. So there will be interest rates and the maturity. So for example, you can you can work around the axis. So there can be percentage and there will be maturity of 1 year, 2 years, 3 years and so on. And interest rates of, let's say, 10%, 12%, 14%, and so on, for example. So over here, yield curve, I would say for a shorter maturity, let's say the rate is 10, for a longer maturity, let us say the rate is going up. For an even longer maturity, it might be going up. This is a normal yield curve which is expected to go up. Usually, as you see, if people are depositing money for a longer period, you will fetch higher return. For a shorter period, you will get a lower return. That is usually, there is a normal yield curve. However, sometimes the yield curve may be inverted. Now, that is a little rare, but the yield curve is inverted because over here, let us say for a shorter maturity, you will get a higher rate. Longer maturity, you are getting lower rates. Now, this is relatively rare, but if that situation happens, this is called as an inverted yield curve, which is going down, and a flat yield curve is where across maturities, the interest rates per annum remain the same. Okay, so we will keep that in mind and work on this question. You are an investment analyst working for a financial advisor. You have been asked to analyze the bond market's yield curve to assist your clients in making investment decisions. The yield curve represents the relationship between the interest rates, that is the yield, and the time to maturity for the debt securities, usually government bonds. For simplicity, assume the following yield data for a government bond over various periods, that is measured in years. So this is for government bonds, the yield curve table. For 1 year, you are expecting a 3%, 2 years, 4%, 3 years, 5%, all this is per annum. As you can see, this seems to be a normal yield curve where as the maturity increases, the yield percentage is also increasing. Based on the above case scenario, answer the following questions. First, the main characteristic of a normal yield curve is, first, short-term yields are higher than long-term yields. No, this is a feature of an inverted yield curve. Short-term yields are lower than the long-term yields. Generally, yes. Yields remain the same across all maturities. No, this is called as a flat yield curve. And yields fluctuate randomly over different maturities. The answer is no. Usually, even if you open bank fixed deposit, you will find that for a 14-day deposit, 3-month deposit, 6-month deposit, 1 year, 2 year, usually the interest rates go up. So that is a normal yield curve. Short-term yields are lower than the longer term yields. Point B. Based on the revised yield data, what is a yield spread? Spread is the difference between the 10-year and the 1-year bond. So the 10-year bond is 7%, 1-year bond is 3%. So 7 minus 3 comes to 4%, seems to be point C, 7 minus 4. An inverted yield curve typically indicates, this is pure theory, it typically indicates what? It indicates a coming recession. Why? If it's an inverted yield curve, it means that the short-term rate of interest is very high, and in the longer term, people are expecting lower rates. Usually, when do central banks reduce the rate? If the economy goes into the recession, to pump in the economy, they will reduce the rates. And hence, generally, what will happen is, in case the longer term interest rates are lower, we are saying that probably in the future, we are expecting a recession, and thereby the central banks will cut down the rates, and thereby, among other things, this can be one of the explanations why a inverted yield curve can show an upcoming recession that is coming. So, inverted yield curve typically indicates no, not growth, not uncertainty, it is an upcoming recession. Point 14. If an investor is looking to invest for 2 years, starting 3 years from now, that is in the year 4 and 5, the forward rate we would expect would be, well, what is the formula that we typically use for forward rates? So this is, let's say 3 years, and this is, let's say 5 years. I would say over here that the forward rate is the rate prevailing in the 4th and the 5th year. I would say 1 plus 0.06 raised to 5. So 1 rupee invested at the rate of 6% for a period of 5 years will fetch you how much? Plus 1.05 invested for 3 years into 1 plus r raised to 2. So this is the rate in the next 2 years. So I'm saying 1 rupee will become how much after 5 years? This is your typical forward rate workings that you do in valuation or interest rate risk management. 1 rupee after 5 years becomes how much at the rate of 6%? Well, that should also be becoming the same value if you invest for 3 years at 5% and then add the forward rate for the next 2 years. So if I do 1.06 raised to 2, 3, 4, 5, this will come to, let us say, 1.3382 equals, let's say, 1.05 raised to 2, 3. This is 1.1576 into 1 plus r raised to 2. Therefore, you will have 1.3382 divided by 1.1576. If I divide this, I will come to, let us say, 1.33 upon 1.1576 equals 1 plus r squared. Therefore, 1 plus r will equal the square root of 1.1560. If I take the square root of this, this will be 1.0751. This is 1 plus r. So, this is 7.51% approximately. So, if I go to see, this will be 7.51 or 52. Let us say if I were to, yes, round it off, it will be 7.52%. Okay. Next, you go to question number 15. If an investor is looking to invest for 2 years, starting 5 years from now, the forward rate he would expect shall be, you can pause and try this on your own based on the same working. You are looking at 7 years and 5 years. You are looking to invest for 2 years, starting 5 years from now, and as a result, you will say 1 plus 0.064. This is the rate for 7 years raised to 7 equals 1 plus 0.06 raised to 5 into 1 plus r for the next 2 years raised to 2. So, if I do 1.064, 2, 3, 4, 5, 6, 7, I think this is 1.5438 equals 1.06, this was 1.3382 into 1 plus r squared. So, if I take this on the other side, 1.3382 comes to a number 1.1536. If I square root this, 1.074. So, if I work around this, ultimately I will get 7.41% approximately. So, your answer should be sub point A ideally. So, this kind of takes care of these two slightly different cases. Apart from that, in your descriptive section, you have question 1A. This is based on a concept called as first Chicago method that we have done in business valuation along with a particular small case. You can refer the old theory which is there on YouTube as well for business valuation, where we have tried to discuss valuation of startups using various methods like the Burkus method, cost to duplicate method, first Chicago method, venture capital method, etc. with small numerical cases, and over here a numerical case has come. Now, when you read this, it might appear to be a little challenging, first Chicago method, but basically this is nothing but scenario analysis. What is first Chicago method? It is nothing but scenario analysis where you have the best case, worst case and the base case, and try to find value of a startup at each of these cases and then consider the final value considering all of these cases along with the attached probabilities. So, let us try to review that. Question number 1A. The ABC startup over here has the following expected profits under different scenarios along with their respective probabilities. So, you have revenue and expenses. So, basically that will come to profit. So, you will try to find the profits. 100 minus 80, that is probably 20. 120 minus 92.4, that comes to probably 27.6. And 144 minus 108 comes to probably 36. So, over here, these are the cash flows in the best case. In the base case, this is what? 10, 110 minus 95.7, 14.3, and 121 minus 102.85, 18.15. And last, this is what? 5, 102 minus 98.94 comes to 3.06, and 104 minus 101.9592 comes to shall say 2.0408. So, these are your cash flows or profits. You are required to suggest the value of ABC startup using the first Chicago method, assuming the applicable discount rate is 20%. Startup is located in a tax-free zone, so there is no tax, and the multiple for terminal value is 10. So, whatever is the final year's cash flow into 10 will give you the multiple. No depreciable assets are held by the startup, so there will be no depreciation and no tax impact. The present value factors are given to you. These three numbers are given to you. Round off the calculation to the whole number. So, what will you do? You will try to find the value based on the present value of these cash flows. Along with that, there will be a multiple maybe of 10. So, this is 36 into 10, maybe 360 at the end. 18.15 into 10, maybe 181.5 at the end. And 2.0408 into 10 comes to around 20.408 at the end. So, what are we going to do? We are going to discount these cash flows at the rate of 20%. So, over here, this will come to, for example, over here, 20 into 0.8333 m plus 27.6 into 0.6944 M plus 36 and 360, probably this is going to equal to 396 if I am not wrong, the total of these two, into 0.5787 M plus and MRC. So this comes to around 265 approximately if I am not wrong. The present value of all of this will come to around 265, which has a 30% probability. So if I were to just verify these workings once, so over here, if you see the first printed solution for the first Chicago method, you will look at the base case scenario, cash flows at each of the years, and then the terminal value. You see 264.99 or approximately 265. This is the value in the first scenario. You will do a similar working in the second scenario. इसके बाद तो आपके calculator का ही काम है. You will do a similar working in the second scenario, third scenario, and then three numbers will be there. Find the probability based weighted average. So this is 265. Second case, as you would have expected, 10, 14.3 and 18.15. Apart from that, so as you see 10, 14.3 and 18.15, and last my terminal value will be 181.5. So this is terminal value of 181.5. You discount these values and get approximately 133.08, and then in the worst case get a value of 19.53. Now the value of the startup is considering all the three, considering the probabilities, 30% probability for your best case, 60% for your base case, and 10%. So basically, if you go to see 265 into 30% plus I think 133 point something was your value if I am not wrong, 133.8 into let us say 60% and last may around 19.5 or something into 10%, and that is about it. That will give you the value. अगर ये first Chicago नहीं दिया and they told you doing scenario analysis, it is the same thing. So this is a value that you will get considering all of these. As per the first Chicago method, this is a value that you will be getting. Are we clear with this? So it might sound to be a little challenging, but it is by and large manageable, and this is probably the only question which might be slightly different. Now question 1b as well, it is on FCFE and it is very similar to a problem that we have done, just that there is a small difference over here which I want to highlight, and that is about it. So over here, calculate the value of one equity share of X from the following information. You have all of this data. Generally in your study material, a very similar question is there, and looking at this you might say, ये तो same है. It is by and large same. Just that in that question you were given the debt ratio. But in this question you are given new debt to be issued for funding. This is new money raised. So here you will not do that 1 minus D working because there is no debt ratio. You will do your regular FCFE working where you will first take the PAT. Over here I think everything is given in crores only, so your PAT will be 8,000 plus depreciation if any. So if there is chargeable depreciation, this is 17,100. We will not look at interest if you are doing FCFE. Minus increase in working capital, total increase in working capital will be 1755.6 minus increase in fixed asset, that is capital expenditure, minus 20,140. Now usually you used to do a 1 minus D adjustment for certain cases. Here you have been given new debt issued for funding, so this is new debt issued, so that is money received 2062.108 probably. So this will be your value, and hopefully if you do that, that will give you the free cash flow. So 8,000 plus 17,100 minus 1755.6. Oh, this was profit before tax. I'll have to subtract tax. I think there's a tax rate of 30%. So this is not 8,000. This is 8,000 after deducting tax. So this is 8,000 into 0.7, probably 5,600. So maybe 5,600 plus 17,100 minus 1755.6 minus 20,140 plus 2062.108, शायद से around 2866.508 will be the free cash flow. Obviously you will have to adjust for growth and do the Gordon based valuation, but if I were to look at the free cash flow, at least the free cash flow over here seems to be 2866.508, and then the working would be done in a similar value. So this is FCFE 0 into 1 plus G divided by KE minus G. KE can be calculated using CAPM. Just that over here you will have the net issue which is given. This is the new part instead of the debt ratio. Other than that, this is by and large similar. So this I would say takes care of your MTP. You can try the sensitivity analysis problem as well. But to be honest, this is very similar to the problem which is there in your study material also. So first we'll see if there is anything else that we need to kind of cover. So we'll go to the next MTP, which is MTP series 1. Over here also there is a scenario 1 which is similar to your repo rate questions, though in an MCQ setup we did this in money market, but it is good that you practice this separately. So case scenario 1 is something that you should kind of try. Bank A is in the need of funds for a period of 14 days. To meet this financial need, on 20th September 2023, Bank A enters into an agreement with Bank B under which it will sell 10% Government of India bonds issued on 1st January 23 at 5.65%. This is your repo rate, the rate that will be charged for the repo based borrowing, whereas 10% is the rate on the bond. For 8 crores, face value of the bond is 10,000. So if you look at 8 crores divided by 10,000, you will probably get the number of bonds. I think this will be 8,000 bonds. The clean price means the ex interest price of the bond is 9942 and the initial margin will be 2% and the maturity date of the bond is 31st December 2028. So the bond is still continuing. Consider 360 days in a year and interest is payable annually. So there is no half yearly payment. So the last interest payment, if the bond was issued on 1st of January, the interest payment will come by 31st December each year. So currently, when I look at this bond, if I want to find the dirty price, I will also have to calculate the accrued interest. Question says consider 360 days in a year. So you'll have to calculate in terms of days. We can take the actual days or we can take 30 days in a month. Institute, I believe, has taken in this case actual days in the calculation, if I'm not wrong. So over here, ideally they say 360 days are taken. That means each month can be taken for 30 days. But because यहाँ पे something is happening at 20th of September, we'll have to take the actual days. So if you were to take the actual days, it is as per ICAI what it has taken would be 31 days in January, 28 days in February, 31 in March, 30 in April, 31 in May, 30 in June, 31st in July, 31st in August, and then how many days should you take? Well, this arrangement is already entered into on 20th September and hence for the first 19 days you will do the arrangement. 20th day you have already given the bond. So till 19, so this is what? 31 plus 28 plus 31 plus 30 plus 31 plus 30 plus 31 plus 31 plus 19. I believe this is 262 days. Maybe someone can even argue and take 263, but let's say it should be 262 days. This is what the ICAI has done. So your interest is always a percentage of face value. So on a per bond basis, you will have 10,000 ka bond into, remember bonds interest rate is 10%. Don't confuse it with 5.65%, that is the rate under the repo, into 262 but divided by 360. So this is 1000 into 262 divided by 360 will probably come to around 728. This is your interest. Now your clean price is 9942. So if I want to find the dirty price will be 9942 plus 728. 9942 plus 728 comes to around 10,670. This will be your dirty price. There are probably 8,000 bonds. We'll see what is asked over there. Based on the above case scenario, answer the following. The arrangement between bank A and B is called as call money, commercial bill. No, it is a repo, that is repurchase deal. So it is point D. The dirty price of the bond, we just calculated it as 10,670, option B. The start proceeds of the transaction shall be approximately, so this is like your loan. So there are 8,000 bonds. Each bond is worth 10,670, that is a dirty price. However, the loan is based on a minus 2% initial margin. So minus 2% into 8,000. If I go to see, this will be around, that's a fairly big number. Because as an initial margin, you can subtract that. This is 836, 50 to 800. 836, 50 to 800. So maybe you round it off to the nearest 836, 53. It seems the answer is B. Okay, on this value, there would be certain interest. This interest will be levied at 5.65% for a period of 14 days. So this on which you will add 5.65% into 14 by 360. So if I take this number on my calculators, 836, 53 let's say in the memory, into 5.65% under the repo into 14 by 360 M plus. Your interest is around 1,83,804. Total is 838, 36,804. 838, 36,804. Perfect. So your answer is this. How did you calculate this, sir? Initial proceeds, that is the loan value of 8.36 plus, let us say, 5.65% for a period of 14 by 360. Remember, in a repo, what is happening is, in this case, if I go to see, there are two banks. Bank A is giving bonds to Bank B. These are bonds worth 8.365 crores approximately. Against this, so these are bonds that I am giving, against which B will give the money today, that is on 20th of September. B will give, so I will give bonds, and in return, B will give me 8.365 crores today. Now, after 14 days, B is ready to give me back the bonds. However, I will have to give back the money. How much will the money I will give back? 8.3836 or something crores is what I will give back. That is whatever I have taken plus the interest. For a detailed explanation of repo, you'll have to refer separately for the money market, where we have done a sum along with our valuation video. You will see a detailed discussion on this. You will get a better understanding. But over here, this is the value, the amount of accrued interest per bond. I think it was 728. As we saw over here, this was 728. So this was the accrued interest. We are giving up a bond which is worth 9942 plus accrued interest of 728. That is 10,670 worth of bond we are giving up. In return, we are getting, let us say, money. Usually when the banks lend money, they, like when you take a housing loan, if the house is worth 100, the bank does not give you 100 worth of loan. It will deduct some margin and then give you a loan. Similarly over here, if you give a bond worth 10,670, it is not necessary to get exactly the same. So there's a 2% margin. So for a security of 10,670 minus 2%, I will give a loan of approximately 10,457 or 56.6. That is per bond. There are 8,000 such bonds, and again on this loan there will be an interest of 5.65% for 14 days. Okay, so this is your case scenario 1. Hopefully you can kind of get this correct. Case scenario 2, I would say largely it is similar to your mutual fund questions that is there. Last two MCQs over here are slightly different, so we'll focus on that. The asset management company of a mutual fund has declared a dividend of 9.98% on the units under the dividend reinvestment plan. The 9.98% on the dividend reinvestment plan for the year ended 31st March 2021. The investors are issued additional units for the dividend at the rate of closing NAV for the year as per the conditions of the scheme. So whatever is the closing NAV, that will be the base for the purpose of giving dividend. The closing NAV was 24.95. So you can use that for the purpose of your dividend. Remember, dividend is a percentage of face value. Number of new units you can find based on 24.95. On 31st March 2021, an investor, Mr. X, who is having 20,800 units at the year end, has made an investment in the units before the declaration of dividend at the rate of opening NAV plus an entry load of 0.04. So your investor is having 20,800 units at the year end. They have made investment in the units before the declaration of dividend. So you will be getting additional units due to the dividend at the rate of opening NAV plus entry load of 0.04. What is entry load? This is the additional cost that you have to pay. The NAV has appreciated by 25% during the year. So you can back calculate what your opening NAV must be and assume the face value of the unit as rupees 10. So one can say that if the NAV has appreciated by 25%, if your opening NAV was 100, your closing NAV will come to around 25 more, and hence this is 125. So 125 is equivalent to 24.95, then 100 will be equal to how much? So if I take 24.95 divided by 125 into 100, approximately this will be 19.96. This will be your opening NAV, and you must have invested another 0.04 as entry load. So total 20 rupees must be your total value of the investment initially. Okay, so that must be 20 rupees. The opening NAV of the AMC shall ideally be 19.96 as you can see backwards, it is 19.96. Initial investment will involve another payment of 0.04, but your opening NAV ideally should be 19.96, option B. The number of units purchased shall be. Now 20,800 units are there, but that is after dividend. Now I don't know how much would be there. So let us say the number of units initially were X. I don't know. We can find this as well. Honestly, so if I have probably 20,800 units at the end and the NAV is given to you as 24.95, initially it was 19.96 with a 0.04, you can actually back calculate and try to find the number of units as well. So your additional dividend, well, 9.98% is the dividend. Let's say your opening units was X. X into rupees 10 was the face value into 9.98%. Okay, so this will be your actual rupee value of dividend. Okay, this will be your actual rupee value of dividend. This will be reinvested at the rate of 24.95. Apart from that, opening may you had X units, there are other ways also in which you can solve, and this total comes to 20,800. So if I were to solve this equation, this is 24.95x plus, let's say, x into 10 into 9.98%. This is 0.998x upon 24.95 equals 20,800. So if I were to take this 24.95 into 20,800, this is 5,18,960, 5,18,960, and यहाँ पे 24.95 plus 0.998, this is 25.948x. So if I take this 518,960 divided by, I will get exactly 20,000. This gives us a lot of confidence कि भाई हाँ round number. Thankfully the confidence is correct. You should be getting 20,000 units X. The original amount of investment shall be, so this is 20,000 units into 19.96 plus a 0.04 as well. So over here, if you take 20,000, if I take the total investment, this will be, let us say, 4 lakh rupees. Total investment including the load will be 4 lakh rupees. Which of the following statement about the expense ratio is or are incorrect? So there is something regarding expense ratio. It is a percentage of income that were spent to run a mutual fund. It is usually a percentage of your total assets that is spent for expenses. It includes advisory fees, travel costs, registrar fees, custodian fees. Well, possibly yes. It includes brokerage cost for trading of the portfolio. I think possibly yes. High expense ratio can seriously undermine the performance of a mutual fund scheme. That is also correct. So over here, when we look at these cases, let us see what are the statements which are correct. So over here, in my limited understanding, you will have 0.1 because your answer should be ideally point D. That is what is incorrect. We will say only statement 1 seems to be incorrect. Why? Because it is a percentage of assets, and assets are not the same as income. Your mutual fund might have 100 crores as assets under management and it might have earned a 10 or 15% return. So 15 crores must be the income. So your expense ratio, even if you Google up and find, it is always the ratio of your annual recurring expenses divided by your assets under management. That is generally the case. Over here, they have given, so ICAI, again, what ICAI has done over here is ICAI has mentioned option C. That is, they've said 0.3 is incorrect. Again, 0.3 is not necessarily incorrect. In my understanding, there are two types of plans. One is regular plans and one is direct plans. In a regular plan, the asset management company will appoint a broker through which they would do the trades, in which case they will have to pay brokerage, and that brokerage becomes a part of your expense ratio, definitely. Whereas when there are direct plans, in direct plans, the asset management company itself is kind of like a Motilal Oswal or Edelweiss, where they themselves are having the trading card to trade directly, in which case there will be no separate brokerage which is levied, because they are going to buy or sell directly rather than through a separate third broker. So in a direct plan, there would be no brokerage cost, but if there is a regular plan, in general, a mutual fund has a broker through which they will enter, buy and sell, which is the brokerage cost, which is also a part of managing your portfolio. That is my limited understanding. Again, I might be wrong. However, if I go and a similar question comes in the exam, for us, ICAI has taken 0.3 as correct. Maybe my understanding, if you know something, you can kind of improvise on that. But in my opinion, if I were to read this question on the first instant, I would have said my answer is point D, because this seems to be the incorrect one, though the institute seems to have given point C over here. So there is a little bit of contentious discussion over here possible. Point 2 and 4, there is no ambiguity. Well, in point 1 and 3, there may be some bit of discussion required. So this is a probable question where there might be a slight change. But as we speak, institute has taken point C only. Okay, then you have dash considers the downside deviation instead of total standard deviation in the denominator. So there is expense ratio, Sharpe ratio, Turner ratio. Sharpe ratio is nothing but the reward, that is the return minus the risk rate upon the standard deviation. Turner ratio takes the denominator as beta. Expense ratio is something else only. It is the annual expenses divided by your assets under management. But Sortino ratio, as we have discussed in theory, would be the return minus the risk-free rate upon something called as a downside deviation. Downside deviation is a deviation that is arising when, let's say, there is a fall. So the fall below the market or your benchmark return, that is a downside deviation, and that is what is taken in the Sortino ratio. If the question comes in the exam, they will give you the standard deviation. Total standard deviation is used in the Sharpe ratio. If there's a downside standard deviation given, that is used in a Sortino ratio. Fair. So this is your point 10. Case 3 is very similar to a question that is there in the derivative section as well. We'll quickly kind of touch upon this in the sequence. You as an investor has purchased a 4-month European call option on the equity shares of X for ₹10, of which the current market price is 132. So this is your price today and the exercise price is 150. So this is S0, this is XP. You expect the price to range between 120 to 190 and the expected price of X, and the probabilities are given to you. Based on the above case scenario, answer the following. Expected price of the share. Well, this will be weighted average. 120 into 0.05, 140 into 0.2, 160 into 0.5, 180 into 0.1 and 190 into 0.15. So this comes to, I think, 160.5 if I am not wrong. Again, 120 into 0.05 M plus, 140 into 0.2 M plus, 160 into 0.5 M plus, 180 into 0.1 M plus and 190 into 0.15 M plus, 160.5. This is very similar, in fact, with the same numbers in your study mat. Suppose if the exercise price prevails at the end of 4 months, what will be the value of the option? Will it be 0? Why? Because spotted expiry, if it is 150, exercise price is also 150, the answer will be 0. In case the option is held to maturity, the expected value of the call option should be, if it is held to maturity, then there can be 5 possible prices. Over here, exercise price is 50. So in the first case, payoff will be 0. I will not exercise if the price is 120. 140, again, I will not exercise. 160, I will exercise, getting a payoff of 10. 180, I will exercise, getting a payoff of 30. And here I will get a payoff of 40. So basically, this is 10 into, so this is 5. 30 into, this is 30 into 0.1 and 40 into 0.15 comes to, I think, 14 if I am not wrong. Yes, your answer should ideally be D. In the different scenarios of expected prices at the time of maturity, option shall be in the money. In the money means it will be exercised. When will it be exercised? In which of the scenarios? 3 of the scenarios. These 3 scenarios, there will be exercise. So your answer is 3. In the different scenarios, expected prices, the option shall be at the money. At the money means spot at expiry is equal to the exercise price. Exercise price is 150. Well, it is not there over here, and hence your answer will be D, none of the above. If it was out of the money, then we would have said in the first 2, that is 2 scenarios, it will be out of the money. Now, apart from this, I would say most of these questions, they are quite similar. In fact, they are similar to what is done. So in your MTP 1, bearing the case studies, I don't really see there is much to read. Same is the case with RTP, the last section over here in most of the RTP problems, bearing maybe a few small adjustments here or there, the entire RTP is similar. So if I look at the case studies in your cases, first case is similar to one of the questions in portfolio, just that in there are two of these questions which will require maybe a theory based answer. So we will review that. Other than that, the case is very similar to what is there even in your study mat. Two friends A and N are discussing about the risk. A is sort of risk averse, M is aggressive, that is fine. N said we cannot diversify the market risk at all and quoted the modern portfolio approach. Remember, modern portfolio approach is the approach given by Harry Markowitz. That is a modern portfolio theory. Both friends, Sharp ka theory is the Sharp index model. Modern portfolio theory is given by Harry Markowitz. Analyze the market data for a few months and came out with the following. So market return over here is 7 and 15 on an average. If there's an equal probability, this will come to around 16%. 4 and 40 on an average, this comes to 22%. 9 and 18 on an average, this comes to 13.5%. Average return at a 50% probability. The beta of the defensive stock is, well, if I go to see the defensive stock, well, when the market moves from 7 to 25, that's a, I think, how much is it? 25 minus 7, I think an 18% change. Your defensive stock is moving by 9% and hence the beta seems to be 0.5. If the market return is equally likely to be 7 or 25, then the expected return on the aggressive stock, well, this comes to around 22%. We have calculated the average return and the alpha of the defensive stock. Alpha is either called as the Jensen's alpha or the alpha as per the characteristic line. As per the characteristic line, this is X bar minus beta M bar. So your X bar or your average return is coming to around 13.5 minus beta, that is 0.5 into market, this is 16, and hence if I do this working, this will come to around 5.5%. In this case, if you want to calculate Jensen's alpha, you need more data, like you need RF. You don't have data regarding RF, and hence calculating KE using CAPM might be difficult in this particular case, and hence the institute over here has directly taken, even if you are given nothing, your KE will be RF, that is 0 plus RM minus RF. RM over here will be 18%. What is, RF is 16% minus RF, that is 0 into beta, which is 0.5. So your actual return is 13.5 compared with the required return as per Jensen's alpha, as per CAPM, this will again come to 13.5 minus 8% will come to 5.5. Whether you look at the characteristic line or Jensen's alpha over here, your answer will be the same. Then the modern portfolio theory was propounded by Harry Markowitz. Some people think William Sharp, but William Sharp has given the Sharp index model. Modern portfolio theory, as they call it, was given by Harry Markowitz. People like Stephen Ross, Black-Scholes. Stephen Ross helped us in, to some extent, arbitrage pricing, Black-Scholes for the Black-Scholes model as well. So over here, that is one. Next, as per capital market line theory, the portfolio is lying on the CML over the market portfolio. These are called as diversified portfolios. So over here, when you look at, let us say, the capital market line, in the capital market line theory, again, if the capital market line is the market line going up, on one side you will have the percentage return, on the other side you will have, let's say, standard deviation. Beta is there for securities market line, standard deviation for the capital market line. So if there is a market portfolio over here, if you are exactly on the market portfolio, you are treated to be diversified portfolio. If you are above the market portfolio or below the market portfolio, you can be called as a lending portfolio or a borrowing portfolio, but you are exactly on the market portfolio, this will be called as diversified portfolio. It is more like a theory base. The concept largely over here is CML thinks that your most efficient portfolio is the market portfolio. However, if you want more or less risk as compared to the market portfolio, then along with the market portfolio, you can borrow money, then you become a lending portfolio, or you can deposit money in the risk-free securities, in which case you become a lending portfolio. So, in case of a lending portfolio, you are investing some money in the risk-free securities and investing some money in the market, that is called as a lending portfolio. In a borrowing portfolio, you are borrowing money and investing that in the market portfolio. So basically, portfolios which are lying on this side are called as The borrowing portfolios lying on the other side are called as the lending portfolios, and exactly this will be called as the diversified portfolio. So this is something which is there in the theory for capital market line. The second question on mutual funds is exactly similar. I would say there is even no to one of the detailed questions for mutual funds that you have. If you want, you can read that. It's there in your study material. We have even solved a separate sum on the mutual fund video, I believe. So there's nothing new per se over here. If you want, you can just review this and read this in line with the question which is already there in the mutual fund section. And I mean, just that they've given you MCQs, there's no theory as well. Like in the first case, point 1 to 3 were similar to what we had done, but at least 4 and 5 are different. Yahan pe to, as such, there is nothing else I would read. You would have done this, and if not, please do this, because a question like this has come in your descriptive section multiple times. You mark this as important even for your last day revision. Other than that, in your RTP, I don't really see any separate, very different things. Just that in, let's say, question 3, it's very similar to a payoff question, but you have been told that Mr. H is holding 100 shares. So your overall position will include the position which is payoff from the option along with the share value as well will be considered. Other than that, I think most of your questions are exactly similar, including the utility question, derivatives question, etc. So you have this question regarding securities valuation, where also they have used repo. We have done this in one of the MTP questions, and so I would say there are two places where repo has come. So might as well you can try to do this repo properly. Here repo is slightly different. They have not given you the rate, they are asking you to back calculate. So if required, we'll just try this repo question over here. Bank PK enters into a repo for 9 days with bank JJ in a 6% government of India bond 2022 for an amount of 20 crores. So this is your total face value of the deal. Other relevant information are the start proceeds are 20 crores 67,500. Repayment is 20 crores 3 lakhs. So initial margin is 1.25%. Days of accrued interest are given to you as 240. You are required to assume 360 days in a year. You are required to calculate repo rate. Now, how will I do that? Well, the difference between the two is the interest amount. So this is 317,590 minus 20,67,500. This is 2,50,090 on the base of 20 crore 67,500. Just a second. Yes, 20 crore 67,500. This will be your interest. So if I go to see your interest of 2,50,000, kitna tha yaar? 2,50,090 on the base of 20 crore 67,500. This is into 100 into, I think, 6 divided by, I have to take 360 into 6 divided by 360 will come to, I think annualize karna hai, to into 360 divided by, I think kitne days hai? 9 days, not 6 days, divided by 9. So this is 250,090 divided by 20, 67,500 into 100 into 360 divided by 9. Approximately 5% per annum seems to be the repo rate. This is approximately 5%. Okay, so that is your repo rate. We will just verify that. Then you have the clean price and dirty price that we can find. Clean price is the X interest price, whereas dirty price is the cum interest price. So if you go to see over here, which question is this? I think this was question number 10. Yes, so you will see 5% over here. This is your repo rate. Then you have to find the clean price, where you will start by your nominal value. Nominal value is given to you as 20 crores. Your nominal value is given to you as 20 crores into the dirty price upon 100. Now the thing is, the margin is less 1.25%. So whatever is the nominal value, 20 crores hai. On that 20 crores, how much will be lent? Well, the lending will depend on the dirty price. But what is the dirty price? Well, dirty price is the clean price plus interest. Interest over here will be 20 crores into, I think, what was the rate of interest? 6% into 240 divided by 360. So if I go to see your accrued interest value on your entire value would be equal to, एक सेकंड इसको अब फ्रेश ही कर लेते हैं. So if we go to see over here, just a second, yes. So days of accrued interest is given as 240. Are you given the face value per bond? I think they have assumed the face value to be 100 and solved. If you do it for all the bonds, that will be around 20 crores. So when I look at on a per bond basis, if 100 was assumed to be the face value, let us say, then 100 into 6% into 240 divided by 360. 6 into 240 divided by 360 comes to around 4 rupees, I believe, will be your difference between your dirty price. So this is 4 rupees. So once you can somehow find the dirty price, back calculate it, subtract 4 rupees from the dirty price and you will get the clean price. So how will you find the loan amount? So let us say the loan amount today is given to you as 20,67,500. Now how will you calculate this? Well, this will be calculated as your 20 crores, which is a nominal value, divided by 100 rupees, which will give you the number of bonds, into dirty price. Now I don't know what the dirty price is, so let us say the dirty price is equal to X. Okay, so this will give you a dirty price, and dirty price, let us say, is equal to X. However, when I actually give the loan, this entire amount will not be there. This is minus 1.25%, margin of 1.25%. So this is into point, I think 100 minus 1.25 comes to 0.9875. So if I take 20 crores divided by 100, I will have 2 lakh, I think, 20 lakh bonds. So over here, first of all, I will divide this. So this is 20 crore 67,500 equals, I think, 20 lakhs into X into 0.9875. So 20 lakhs into 0.9875 comes to 19,75,000. So 20 crore 67,500 divided by 19,75,000 will ideally give me X. X will come to 101.3. Now institute has asked you repo twice, and 101.3 may say you will subtract 4 rupees. That will give you the clean price, that is 97.3. So institute has asked this twice, so probably when you are revising, ensure that you kind of put a little more emphasis on repo. MTP may be aaya, RTP may be aaya. So it's an interesting thing. I think that should be it. That takes care of your discussion regarding the important questions within your RTP as well as MTP. I hope this video helps. Keep studying. I'll see you soon with some more videos, and work hard, give it your best shot, and God bless you all. Bye-bye. Take care.